asset allocation. Why did you put that first, Tuck?
Yeah, it's really the biggest driver of a portfolio's returns over time. So, we think about building a portfolio, and I think people's minds immediately go to which stocks are in there. What do we like in terms of a particular name or company? And that's very granular. That's ultimately the most granular we can get. But the reality is, and what the studies have shown, is that your broad asset allocation, that mixture of stocks and bonds for the portfolio, really are the primary factors that drive portfolio returns over the long term.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. This is episode 1 of season 10 of the Guided Retirement Show. Today, joining me is Stephen Tuckwood. He is Director of Investments here at Modern Wealth, also a chartered financial analyst. We're going to be talking about proper portfolio construction as you head into retirement. Enjoy my conversation with Stephen Tuckwood. And before we get into the show, I want to remind you, go ahead and make sure that if you're watching us on YouTube, you subscribe, hit the bell icon. If you find this useful, share it with your friends. And if you're listening to us on your favorite podcast app, make sure and subscribe and give us a thumbs up, and enjoy my conversation with Stephen Tuckwood. All right, Stephen Tuckwood, aka Tuck. You are the Director of Investments here at Modern Wealth, also a chartered financial analyst. This is your third episode on the Guided Retirement Show. Also happens to be episode 1 of season 10. So welcome back, Tuck. Great to have you here.
Thanks, Dean. Really appreciate it.
So today, Tuck, we are going to address a very crucial topic, and that is constructing the proper portfolio for you during your retirement years. And I'm of the opinion, Tuck, and I'm anxious to hear from you as a chartered financial analyst, I think the rules of investing change once you get to retirement, and even those years, 2 to 3 years leading up to retirement, the rules really do change, and it becomes more about making sure that your portfolio can generate income, and it can do it safely, and it can keep up with inflation, where as you're younger, you're really looking for growth. So, Tuck, from your perspective, talk a little bit about why you think that the rules to investing change as you enter into retirement.
Yeah, happy to. And it's really a monumental event from a portfolio standpoint when we transition from the accumulation phase, that growth phase that you talked about in earlier life, where we're, working hard, trying to save money where we can and add into the portfolio. And then we hit retirement and the whole thing switches. We then rotate into distribution mode. And that's really impactful on a portfolio and how we think about the construction of it. But as you mentioned, it's not exactly a binary event. Hopefully, you've been positioning the portfolio in what we call the Redzone, which is the few years kind of leading up to that retirement date, and then a few years after, where market impacts can really affect your financial success later on in retirement if there's a major, let's say, stock market correction during that time. So really focusing on that red zone prior to retirement and then immediately after to transition things from, that accumulation structure into more of a distribution that we need in retirement.
And Tuck, there's these silly, what I'll call rules of thumb when it comes to investing, and especially when it comes to retirement investing, where you'll read an article that says you should own your age in bonds, or you should follow the 4% rule as far as a distribution rate. And if you just do those things, you're going to be fine. What do you think about that?
Yeah, rules of thumb are usually directionally accurate and okay to look at, but the devil's always in the details with these types of things, and what the market's opportunities is presenting to you on the fixed income side, particularly also on the equity side, really come into play there. So just by way of example, current yields in the bond market are just materially different than what they were 12 to 18 months ago. So, that might impact that allocation to bonds relative to stocks, as well as we're looking at the comparison of the two markets, where, the rule of thumb is a little bit, more just plain vanilla. There's obviously a lot more that goes into it than just that.
So, Tuck, we want to talk about 4 specific things when it comes to building the proper portfolio for retirement. First is pure asset allocation. The next is what you call strategic asset allocation. Then we want to talk about asset location, and then asset class implementation. So let's start with asset allocation. Why did you put that first, Tuck?
Yeah, it's really the biggest driver of a portfolio's returns over time. So, we think about building a portfolio, and I think people's minds immediately go to which stocks are in there. What do we like in terms of a particular name or company? And that's very granular. That's ultimately the most granular we can get. But the reality is, and what the studies have shown, is that your broad asset allocation, that mixture of stocks and bonds for the portfolio, really are the primary factors that drive portfolio returns over the long term. And it's way up there. It's just the number one driving factor, where stock selection is actually not as impactful over the long term versus that. So getting that right is, critical, and the really top decision that we should be making.
How does that change, if at all, when you enter into that retirement phase of life, where you're now all of a sudden, you're not just looking for long-term performance, you're looking for that portfolio to produce income. So you may have to have a systematic withdrawal set up and be forced to sell positions at lower prices than what you wanted to if all you did was pure asset allocation. Is that something that could be dangerous to someone in retirement?
Yes, yeah, definitely. And like you say, for required minimum distributions in your traditional IRAs, for example, that's a liquidity event that it's something we need to plan for and position the portfolio for, because the last thing we want to do, and really the key to good liquidity management, is that if we happen to have a large drawdown in the equity market or the fixed income market, we don't want to be pulling money from the portfolio at that time. Actually, quite the opposite. We want to be buying low and selling high. So adding to those asset classes when they have these material drawdowns, rather than pulling money from them at that time to fund a distribution. So liquidity management, to your point, Dean, at the beginning, what's the differences in how we approach portfolio construction in retirement? That is one of the key variables that we think about, is that liquidity need for some of these qualified accounts.
Tuck, you mentioned early on here about how yields on fixed income are different today. So does that cause you as a CFA to think differently about portfolio construction in retirement as we're trying to get income? We can actually get some decent yields on bonds today. We can get some decent yields on tax-free bonds, and we can actually buy bonds, very close to par, maybe a little bit of a premium, maybe a little bit of a discount. So when you get into a scenario like that versus where we were just 18 to 24 months ago, when you were having to pay pretty hefty premiums for bonds, does that change your mind as a CFA on what that portfolio construction should look like over the next 5 to 10 years?
Yeah, definitely. And, we have to adapt the portfolio as the markets adapt. So they constantly in flux and changing all the time. And fixed income is one of those unique asset classes where the bigger portion of returns is what you pay for the bond, and if you hold it to maturity, that's what you're actually locking in, that yield to maturity. So the starting yields for bonds is a bigger reflection of what you're actually going to earn over time. So as that changes, this really gets to the implementation part of portfolio construction. It's that relative decision of the earnings yield of the equity side of the portfolio versus what we can get the yield on the bond portion. Those two things are in flux. They're changing relative to one another, making one potentially more attractive than another. So that's something to think about in terms of your overall asset allocation. And then just within fixed income alone, we're really looking at two measures at any particular time. One is the amount of duration risk that we're taking, just interest rate risk. How far on the curve are we willing to go? And then the other is the credit risk. So we have, treasuries as the risk-free asset. When is it appropriate to add corporate bonds, investment-grade corporates, maybe munis on the taxable side, and potentially high-yield bonds as well? That's the spread component. So we're looking at those two big levers when we're thinking about fixed income implementation.
Tuck, as we build plans, certified financial planners here at Modern Wealth, we will often see where a couple might need to have a distribution rate in the 4 to 5% range, and it's critical to understand that, with interest rates even where they are today, it's difficult to get that type of yield to produce the income that the plan or the couple needs and still be able to keep up with inflation. So talk a little bit about why in retirement we still have to focus on total return and not just income generation from the investments.
Yeah, that's a great point, Dean. And that tends to be what we see on more do-it-yourselfer type portfolio construction folks, which is this idea of always protecting principal and only ever drawing on the income that's produced. And what we find is that often limits the longer term growth potential of the portfolio. So another way to approach that would be, you have a desired yield that the portfolio needs to produce for you to maintain your lifestyle. But there's two ways to go about that. You can create your own yield from being in growth assets that appreciate over time, and then trimming those back and using more of the corpus of the portfolio to generate that return. It's not always the best approach to just maximize yield on a portfolio and leaving very little growth on the body of the portfolio. You can ultimately, what I'm describing is creating your own yield from different portions of the portfolio over time.
So you're looking for total return. So let's say that you need a 5% withdrawal. We need a total return of 8 so that we can keep up with inflation and be able to continue to increase our income over the years so that our lifestyle doesn't diminish. And so is that where you go from pure asset allocation to then more strategic asset allocation, Tuck?
Yeah, then that's the key, I think, is, we think about portfolios and, what is the right way to construct a portfolio? Well, it's a very personal situation. It's a very personal question. Every portfolio will and should be different because we have different goals and objectives as individuals. So the strategic asset allocation point is really just focusing things back onto a financial plan. And, we're obviously very financial plan focused here at Modern Wealth. And that's our North Star when it comes to portfolio construction, in that the client has gone through both a risk tolerance type of questionnaire or discussion to find out what that objective is, but also then other life events that we're planning for. And the job of the portfolio is, for any particular individual or household, is to achieve their financial goals with the least amount of risk. That's really the framework that we set up at the onset for we're constructing portfolios. So, with that in mind, that's a very different discussion than what you might have when you're just thinking about portfolio construction in general, which is, let's maximize for return or whatever it might be, or a yield target. These numbers are quite arbitrary, but a financial plan really brings it back to the client, makes them the focus and their own personal goals, rather than just some abstract number that we need to achieve.
Yeah, Bud Casper and I coined a phrase for that several years ago, Tuck. We called it your PRI, your personal return index. What does your money need to do in order to get you where you want to go and allow you to do all the things you want to do? And how do you construct that portfolio to do that with the very least amount of risk possible? So you're spot on there. And then we go, Tuck, to asset location, which is what tax bucket should you own the stocks in? Which tax bucket should you own the fixed income in? Which tax bucket should you own the alternatives in? And so, Tuck, you can say, Dean or one of our other CFPs, here's how the portfolio needs to be constructed. But then we've got to bring that CPA in to say, okay, from a tax perspective, where do we put the stocks? Where do we put the bonds? Because you don't just take your asset allocation that you come up with and say, look, we're going to do the same asset allocation in our taxable account as our tax deferred account or our tax free account. So talk about how you think about that from a CFA perspective, Tuck.
Yeah, definitely. And you're right. Having a CPA to draw upon here is really crucial, and a CFP focus as well. Yeah. So if you think about just three kind of broad buckets, right? You have your regular taxable account, which every decision you make in that portfolio is going to be subject to taxes. So if we reduce equity exposure there, there's likely going to be a tax bill that needs to be paid. Then there's the retirement accounts where there's a required distribution at some point where the money has entered that account on a pre-tax basis. It's been allowed to grow tax-free, which is really great. And the final part of it, when you pull that money, it becomes a taxable event. And then the third part, which is after-tax money goes in, grows tax-free, but comes out tax-free, which is the Roth style of accounts. There's three distinct buckets that we can fill with different asset classes as we're constructing the overall portfolio itself. So, that's something we see quite often where a couple might have done a tremendous job in growing those traditional IRA accounts, and they've got a great nest egg there, and they're not really aware of how big their tax bill is going to be in retirement as they're having to pull there. So we really like to ideally distribute their wealth across these three accounts to give us the most amount of flexibility. When it comes to asset allocation, there's a kind of back to a general rule of thumb here: the growthier stuff in that Roth, because let's grow that as much as we can. It's growing tax deferred, and when we pull from it, it's not a taxable event ultimately. So, just some high level things to think about as we're looking at that overall portfolio, and then where and what do we fill into each of those three buckets?
Well, I think in order to really do the asset location, Tuck, that CPA has to get involved, and we have to understand what the spending plan is. And so how much income is going to be required to be generated, and from which tax bucket are we going to pull from, first, second, and third, or what portion on an annual basis. And as a general rule, you want the assets that you're going to be spending over, say, the next 3 to 5 years, you want those in something that's very, very safe, so that we're not forced to do something like we talked about earlier and potentially sell one of our growth assets that may be temporarily down in price.
Exactly. Yep. All feeds into it and knits together into a really comprehensive financial plan, but also a tax planning piece of it as well.
So you got to have the CFP to build the plan first. Then you got to have the CFA to say, here's the proper portfolio construction. And then the CPA comes in and says, hey, from a tax perspective, here's the way to do this in the least taxing way possible. So you've created the plan, you've painted the future, where you want to be, what you want to do. The CFA comes in and says, here's the proper portfolio construction. And then the CPA says, this is where the money should be located. And then you're off, and then you're just kind of reviewing and monitoring and making adjustments as they need to be made based on current economic conditions.
Mm-hmm. Yeah, exactly right. Yeah, and that's kind of the ideal state that you want to get to. And then the maintenance is there, obviously, but then we're optimizing in various different ways that perhaps people aren't thinking about initially.
And so that brings up the final bullet point on the things that you want to discuss with the proper portfolio construction for retirement. And it's asset class implementation. And one of the things that you talk about there is, when should you be passive versus when should you be active? And so can you talk about the difference between passive and active, and then how do you determine when you should be in each?
Mm-hmm. Yeah. So, generally active versus passive is, let's just take US large cap equity. So that's part of your overall portfolio, a slice of it. How do we get that exposure? That's the implementation question. We could go active, which is what a lot of folks do in terms of choosing a mutual fund, an active mutual fund, where there's an underlying portfolio manager who's actively trying to outperform that benchmark. Let's say it's the S&P 500. So that's the active piece. You could also just opt to go passive, which would be more of an indexed approach where we just buy an ETF, let's say, that tracks the S&P 500. So not trying to outperform it over time. Well, that decision of whether to go active or passive should be based on how efficient you think that particular market is. So let's, S&P 500, an example, really difficult to beat that benchmark consistently over time for any active manager. That's what the data shows us. So there we might be leaning more towards a passive or indexed approach. because we feel like that market's really efficient, that the alpha potential is low, versus maybe emerging markets, let's say, where more following that index might not be an optimal approach, where we might want to bring in a portfolio manager who can tilt the portfolio to higher quality emerging market names versus just the overall emerging market index itself. So that's what we mean by choosing between active and passive, and maybe when to do it and when to go in a different direction.
And the small cap would be another area where you might want to take a closer look at active management versus passive as well.
Yeah, definitely. Yeah. And a lot of this should be just based on empirical data as well that helps guide us with that decision rather than us declaring what's efficient or not. And the small cap's another good example there, in that it's been shown that when you tilt the portfolio to higher quality names, there's a more of a premium over time than just including all those more unprofitable smaller companies in the junkier side of the Russell 2000, let's say. So
let's talk a little bit about the benefits of portfolio tilts and how you apply those portfolio tilts, and then something else that you talk about, intentional risk taking. I mean, those may be two separate topics, Tuck, but let's address those.
Yeah, they're actually related to some extent. So we've got to the point now where there's a financial plan in place. We know our objective of getting there to the goals with the least amount of risk. We have that strategic asset allocation output, and we're implementing towards that. So strategic is describing something that's longer term in nature, so that asset allocation over a longer term period. What we know is that over shorter periods of time, there might be opportunities that the market offers. So maybe it is more of a drawdown in the equity market that we can see as an opportunity to tilt the portfolio more into that. So let's just say the strategic objective is a 60-40 portfolio. Rebalancing helps with this, as one side of the ledger declines more than another, gives you that opportunity to rebalance back to weight, 60-40, let's say. But maybe you want to tilt it a little bit more. Maybe it is a great opportunity to go 65-35. So that would be the tilt in that situation. Or even more granular than that, on the equity side of the portfolio, let's say international stocks have not kept up with domestic stocks for a period of time, and we see opportunity there on a relative basis. That gives you the opportunity to tilt the portfolio more towards international stocks versus domestic that might be slightly away from the strategic asset allocation. And then, but that's all that's got to be intentional. So that's what we mean by that intentional risk taking, is that added tilt. It needs to be cognizant of that decision and the potential impact of, hey, what about if we're wrong? Or what about if the dislocation persists for a longer period of time? Well, what's the impact to us and our strategic objective based on that? So ultimately just being thoughtful in the tilts that we're taking.
And would you apply the same methodology of thinking, Tuck, in even just breaking apart, say, the large cap sector? Like something we've seen during the 2023 year is a big dislocation between the performance of the S&P equal weight ETF versus the S&P cap weighted ETF, where we've got a disparity that we haven't seen in 2.5 decades, probably since the late 90s. We've got this huge disparity. There's a lot of stocks within the S&P 500 that you and I would consider, from just a valuation standpoint, to be bargains, to be undervalued today. But those stocks are also underperforming the rest of the market, some of them even in negative territory today. But if you follow the rule of thumb that you should buy low and sell high, you could tilt towards an equal weight ETF versus a cap weighted ETF, so that you reduce exposure to the high flyers that are out there with PE ratios that are out of control, and you're adding more to the more value oriented type companies. Is that something you would apply as well?
Yeah, that'd be one of those potential opportunities in terms of taking a tilt. So when we see things like that, I'm always reminded of the old adage of trees don't grow to the sky. So if you think about that dispersion, almost like a alligator's mouth, where, in this case, that Magnificent Seven selection of stocks have done this and the general markets move more sideways, at some point that has to come together, and it can do so in one of two ways. Either the rest of the market ultimately catches up with the Magnificent Seven, or the Magnificent Seven come down to meet the market. But in either direction, that's a tilt that could potentially be advantageous. But you have to be brave, and you're swimming against the tide to some extent.
Well, we actually did see that occur in November of 2023, where the return on the equal weight S&P was almost identical to the return of the cap weight. And so that could be a sign that, maybe there is some value there that's being recognized by different investors, and maybe shying away a little bit from that Magnificent Seven because they are so pricey.
Mm-hmm. Yeah, exactly. Yeah.
Chuck, there's one last thing you had on here is alternative forms of risk. And when we talk about alternative forms of risk, is how do you think about alternative asset classes in the overall portfolio construction for someone heading into retirement?
Mm-hmm. Yeah, great question. And often this is where it gets just trickier from an implementation standpoint, because we're thinking about alternatives and alternative forms of risk. The primary two drivers of a traditional portfolio is that equity beta, just this slice of the equity allocation, and then the fixed income portion. And on rare occasions, we have years like 2022 where both of those types of risk have negative years, and very, very painful to go through that, because normally what we want is that kind of offsetting effect where your fixed income helps shield against portfolio losses in a declining equity market scenario. So then we think about, okay, well, what else could we bring into the portfolio as an asset class that could maybe offset occasions like 2022? And there's various forms of that. One is this idea of a illiquidity premium, where we get added return for locking up capital for longer periods of time. So both public equities and fixed income, general fixed income, rarely liquid markets, and we can sell, any day the markets are open and get a fair price. If we lock up capital into a different vehicle,
private equity, private credit, those types of things.
Exactly. Yep. So we're doing that. We should be, have a more of a favorable return versus a more liquid asset, just as a general rule, because you're foregoing that ability to get your money out at any particular time. So that's where, asset classes like you mentioned there could come into play for a portfolio. And the other is, frankly, real estate. So on the equity side, if you really dig down into like the S&P 500, there is an allocation to public REITs, public real estate trusts in there, but it's quite small. The overall market for commercial real estate is really big, huge, and it's not well captured in just that one little slice of the equity market. So on the private real estate side, that's another asset class that could potentially be included in a portfolio. But again, there's likely going to be money tied up for a period of time, because real estate transactions are very clunky. It's not a liquid market. So yeah, those are some of the things we think about on the kind of periphery of the portfolio, what we can bring in to help continue to diversify over time.
So Tuck, let's just recap really quickly here for our listeners and viewers. Asset allocation, number one driver of long-term performance, but then you have portfolio tilts that you could tilt heavier towards stocks or bonds, or you could tilt heavier towards value or growth, or tilt more towards international or domestic. And then the asset location is, again, critical from a distribution and spending perspective, and also from a tax perspective. And then ultimately, you can come in at the end of that portfolio construction and say what alternative asset classes may have a place in our longer term growth buckets to try to enhance return and give up a little bit of liquidity, so that last bucket that you might include, and it obviously doesn't get included for everybody, but that's going to be money that's going to be spent, 5, 10, 15 years down the road. It's not part of our spending plan in those early years of retirement.
Yep, exactly. Yep.
Tuck, I appreciate you taking time to join me here on the Guided Retirement Show, 3rd episode, many more to come. Enjoy the rest of your day, Tuck. Thank you.
Great. Thanks, Dean. Appreciate it.
Thanks for joining us again here on the Guided Retirement Show. I hope you enjoyed the conversation with Stephen Tuckwood. Make sure that you have subscribed to the Guided Retirement Show, and make sure you share this episode with your friends.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.